This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
Hey, Mike.
Hey.
How are you?
Not too bad. Long time no chat.
I know, it's been far too long. I keep forgetting you're over in Saigon now. How are you enjoying that?
Saigon has been one of the stops. I'm currently in Thailand, so next is Bali, and after that, I'm really not sure. We'll see.
So, how long have you been doing this tour?
I've been here since February 1st.
Okay, all right, nice.
Yeah. So
what you learning?
I'm learning that I don't know much about world history, even though I actually like to think of myself as knowing something. When you get amongst other people in their home countries, you learn quite a bit, right?
Sure, of course, yeah.
So, I mean, especially, for example, to spend 2 weeks in China, and that was a real educational journey to appreciate. Sometimes maybe on the outside you hear, well, communist China and isolation and all this, and then you get in there and you realize they are, as a country and as a people, for a reason. You know, it happened. Things happened to them, and that's how what you see today is a result of things that happened a long time ago. Yeah.
You
know, it's all good. How are you?
Cool. I'm very good. Yeah, all's well. Doing really fun time of life here with kids. My kids are 14, 11, and 8, and family's great, and business is coming along nicely, and seeing some trends here lately, which is always more fun. So all is well.
I was thinking for the audience, I was going to say, I guess we met each other for the first time in, I think, 2001. I think.
Yeah, that's right.
We probably
that was I believe, right? That was 2001. Wow.
Yeah, and we probably emailed each other long before that, I think.
Yeah, I suspect we probably had a couple emails back and forth. But yes, first time I met you, I guess we met a couple times at various conferences and things here and there since. But you guys, you're doing a great job with your website, and it's really evolved quite a bit. And you must be proud. You're doing some good work.
Yeah, well, it's like anything. You start out, and you know this based on your work and your building of Acorn, which we're going to talk about. You get started on one path. The next thing you know, you wake up a few years later, and you're somewhere else.
That's right. Yeah, just day by day, it all adds up.
And I want the audience to understand. So as we just start chatting away here, I am talking with Jason Russell today, and Jason is with Acorn Investments out of Canada, and we are going to get into a lot of the different things about how he started his business, his strategy, and I implore everybody to go look at his webpage and look at his strategy page right off the bat, because it just kind of grabs your attention. I always love to see unique perspectives of how people describe their strategy, especially if it's in somewhat similar world to my world, because then I would just want to steal their ideas. So.
Thanks, Mike. Yeah.
No, it's great, because I like look right out of the gate. You come out on your strategy page and you say how we make money. Step 1: research and identify price movements that repeat over time, and you make it easy for people to understand.
I think that's really important in this space. It seems for many that this is perceived as a black box, and it really isn't. It's so common sense, and in terms of ultimately what we do. And I believe that some in the business may have done a bit of a disservice to the investor in terms of helping them really feel comfortable and understand how we work. It doesn't have to be explained sometimes as scientifically or mathematically as it is, despite the fact that it is mathematical and scientific. The value investment style that Warren Buffett has done a wonderful job of promoting is certainly an approach, and probably one of the best things he's ever done is really just make it sound so simple. And ultimately, I'm sure he's rather sophisticated in his process, but he's able to explain things in a way that really kind of resonate with people and make sense. And that serves the investor, many investors that are busy with other things in their lives and don't want to be a portfolio manager themselves. They want to hire portfolio managers. It's still good for them to have a sense of comfort as to how things are done. So we try pretty hard on, the strategy page there. I think really kind of answers the question, which is most people ask is, how do you make money? So we outlined it there, and we've got a couple other ways of really explaining it.
Why don't I let you jump right in there, though? Because some people perhaps have not heard of you. They maybe have not heard of Acorn Investments. Why don't I let you kind of
Global Investments.
Okay,
I think there's an Acorn Investments somewhere else out there, actually. So Acorn Global Investments. Yeah.
Well, you better do an HTML fix, because I'm seeing in the title tag of your HTML it says Acorn Investments, and the word global's not in there.
There you go. Okay, so, we're on it.
As a longtime search engine guy, I'm seeing. So let me ask though, why don't you go ahead, since I've brought up this strategy page and we're jumping right in, and I know it's probably the heart and soul of what you like to get into. Why don't you kind of go through that and maybe explain to someone who's not heard of your business, not heard of you, and maybe go through the whole process of explaining your strategy, how you make money.
Sure. Well, I think the best way, the way I like to start to explain things is really kind of to go with this with an analogy that I think is also maybe on one of our little videos on the website there, but I call it the baker analogy. And when we manage the portfolio, we look at our portfolio very much in the way a business owner looks at their business. So imagine you're a baker, and every day you need to, pardon the pun, allocate your dough to a variety of different baked goods, whether it's a croissant or a muffin or a pumpernickel and so on. Every day, at the end of the day, you observe, what am I throwing out? Because baked goods go bad. Maybe they sit on the shelf for 2 days, but it's a very quick feedback as to, what do I need what am I throwing out every day? And what sold out? And a good baker would want to, ideally, at the end of the day, have everything on his shelves be gone, but not a moment sooner. So if at the end of the day you're throwing out loads and loads and loads of pumpernickel, a good baker might decide the next day to allocate less dough to pumpernickel and more dough to croissants, which perhaps sold out by 11 o'clock in the morning. And it's a simple act of responsibly allocating your dough to the various baked goods that are out there on the shelf. Basically, coming back to observe what is moving, get out of those things that are not. And there's a whole other group of layers to this analogy that we could get into. But really, it's very much running a portfolio with this approach is very much like running a business with an inventory of goods. You're not emotionally attached to croissants. You're not emotionally attached to pumpernickel or muffins. You don't care. You want to make good. You obviously want to have good quality products, and if they're moving, you're going to allocate more resources to them, and if they're not, you're going to put them on sale, get them off your shelf, and make room for things that are moving. That's what we do when we observe what's happening with the Japanese yen, equity indices, cotton, sugar, cocoa, anything we can find in the world that is highly liquid, and we're able to move in and out of quickly. So I think this is just sort of an alternative way of explaining what we do that we find to be very, very helpful to get people clicking as to what we do. Unplug my phone.
You're a very popular man today. That's a good sign. Yes. That's a good sign. If they're calling all the time, this is a good thing.
Yes, exactly.
So listen, but you've got this great expression on your page, and I don't know if I've ever really seen it. It's very simple, but winners stay, losers go. I like that.
Yeah, and it is really that simple, and that's what we look at every day. One thing we do that I think is unique, I haven't seen anyone else really do it, is every 2 weeks we show our investors every position we have, and we call it our transparency report, and it's a cool little chart that shows bars that shows the P&L of everything we have on our portfolio, and you can very quickly tell whether we're doing our job. our job is to execute this winners stay, losers go process, which is the same job the baker does. You're able to tell very quickly whether, if there's a large losing position that we have not exited, it stands out like a sore thumb. It's our job every day, and our live risk management system basically has the exact same chart that we observe on a daily basis, and we know we've got our exit prices in daily, and that I think also gives investors great comfort, because sometimes this strategy doesn't work. We spend a fair amount of time letting the losers go, but we're very effectively executing our process. And that's really what we, in the short term, need to measure ourselves by. You execute the process and you allow your success to happen. That's really, one of the challenges, I think, of this strategy for those that want to execute it. It's one thing to go and develop an approach and a system. It's another thing to stick to it. There's a process I think anyone needs to go through to really kind of get comfortable as a portfolio manager to really kind of stick to these processes. It's fascinating. I think there's a real neat combination of math and psychology in this business that certainly has attracted me for many, many years.
Well, let me get at something here too, so the audience can follow along. So, and we could have a fairly lengthy discussion about this, but I think you and I both know terms like commodity trading advisor, managed futures, trend following, quantitative trading. All these terms don't exactly describe what many of the people that are your peers, many of the historical legends that you and I both know, doesn't necessarily exactly describe what you do. Would you today fall still under the trend following umbrella to some degree?
Yeah, I mean, ultimately, you could argue that everything is trend following. If you decide that you want to enter something, take a position long the equity market, well, you need a trend to happen after that decision. Otherwise, you either don't make money or you lose money. And so trend following is really the heart and soul of what we do. We probably are not the standard. I mean, there seems to be there's a variety of different trend followers out there. Some will go short term, some are long term, and everything in between. There's the counter trend guys and so on. Ultimately, I think the whole process of everyone trying to bucket things has made it confusing for the investor, because everyone has their own terminology, whether it's managed futures, CTAs, systematic traders, global macro, systematic global macro. There's really a whole bunch of names for what ultimately is process-based investing. Very methodical, responsible. I'm just talking out loud here. I don't know if I'm not trying to invent a new name tag for it, but ultimately what we see ourselves doing every day is winners stay, losers go. We're responsible with the amount we're allocating to everything that we do, and ultimately it's less about the technical reasons for entering a position and more about just observing, where am I making money, where am I losing money. Let's get out of the things that we're losing money on, and when you initiate a position, you ask yourself a very simple question. You basically do something here. You define where it is that you're wrong, and when that happens, if you get to that price where you're wrong, you get out. And that, what do you call that? I don't know. But this approach tended to start in managed futures or in futures markets, but the same common sense approach works in individual stocks, investment grade bonds, convertibles, real estate, high yield bonds, anything that has any sort of price to it. The approaches we use, this common sense approach that any business owner can relate to, just works.
I wasn't trying to put you into a corner with the jargon, but I think the audience can hear in your voice that you'd much rather go through the process of explaining your process as opposed to being backed into a corner and having to defend some one-term jargon that doesn't necessarily describe your entire process.
I think that's right. I mean, there are some that can almost get religious about their label, if you will, and I'm not so religious about labels. Ultimately, it's like any good business owner. You know, if you're running a large store like a Walmart, and purple volleyballs are selling like crazy, you don't care why. You're just going to make sure you got lots of purple volleyballs in stock to satisfy. You don't want anyone walking in your store who wants a purple volleyball walking out without one. And I just kind of keep coming back to that. So I don't know, what do you want to bucket that in? But if you can find, it's really just simply observing. We observe. We're observers. If there's a bucket that I'm comfortable with, that's a pretty good one. I'm a responsible observer.
Let me ask Jason, for the audience out there, let me take you back. I think your firm's track record currently, you're about 8 years right now?
Correct. Yep.
So before that time, though, I believe you were on Wall Street. And do you want to talk about how some of your beginnings and how you eventually came to have the thoughts about the processes that you have now and your strategy and any influences? Go back a few years and maybe go back in time and kind of lay the foundation for how you've come to be where you are today.
Right. Well, I'll try to make it speedy and not get into too much detail, but I'll tell you that, I'm trying to go back to the, real first time that I kind of was inspired was in grade 10 in my economics class. We had to do a project on the markets, and basically I can't remember the details, but essentially it was find a few ways to figure out how they work. Maybe the professor was trying to get some answers from his class. I don't know, but I remember going to the library and looking through all these books, and there's macroeconomic approaches, there's fundamental approaches, and then I came across a book with a bunch of price charts in it that had bank stocks and bond prices and commodity prices in it, and I noticed all the charts kind of looked similar. They all went up or down or sideways, or some of them really went up, or some of them collapsed, and some of them just kind of wiggled around, and something at that point kind of resonated with me, and I think that's kind of where the seed was really planted for me. And read some books that many did in my, in the sort of mid to late 80s, Market Wizards and Reminiscences of a Stock Operator, that type of thing. And the passion was fueled very early on. And in Canada, there really was not much of an industry, if you will, for CTA, managed futures, global macro, and worked at Bankers Trust for a while in the equity derivatives group, and then moved to a firm that was a predecessor firm in Canada to Merrill Lynch, and began building a book of private client assets, and built that up to about $130 million, and had a fine time doing it, and got my CFA at the time. And I literally recall there being a page and a half of work on technical analysis or quantitative analysis. That has since changed dramatically. But, I was always exploring ways to trade more efficiently. And in the very early days, I began writing trading systems back on TradeStation software, and taught myself to program. And as I built these portfolios for clients, I found that I needed something that was different and unique rather than many of the traditional products that I had at my disposal as an advisor at Merrill Lynch. So, in fact, this is funny. In fact, a friend of mine sent me a link to the George Patton speech you have on your website. And that led to, me digging a little deeper, in fact, and sort of taking my trading to another level, and, learned to program in a few other languages, and started developing some systems that I felt were testing well enough for me to start really putting my own money in, and effectively over the next 3 or 4 years began my own individual track record, which certainly had its bumps in the beginning, but got better and better as it was. We had some good trends back then, and Eventually, I decided to move on. A large bank bought Merrill Lynch here in Canada, and I basically moved out of that business and started the track record that we have now in 2005. So that's a real speedy zip through things. You and I met in the Virgin Islands in 2001, and really for me, it's just been a passion for a very long time. I absolutely love it. I think it's a fantastic combination of, for me, of psychology and research, and that's kind of really quickly how I kind of got started. Now there's other stories with, I worked with a large hedge fund here in Canada. The reason I started the fund was this large firm had a wide variety of resource-focused equity managers, and a friend of mine who worked there wanted to bring me on to diversify things, and I did that. But in 2008, I learned some incredible lessons, witnessing firsthand what happened in 2008. But our other funds, not the one I was managing, prime brokered at Lehman UK. And I'll never forget the morning walking in when that all unwound. It was just shocking. But we were up 22%, and I ended up sending all my money back to our investors because I was concerned about the mothership, if you will, and then evolved to start Acorn 6 months later and received many of the investors' monies back and began growing our firm. And for me as a trader, I felt that was actually, while it was a challenging time for sure, for me as a trader and a portfolio manager, being able to design and build the environment that I work in has been fantastic. It really, truly is supporting, my efforts. Previously, and there's a lot of people that have to deal with things like being in an environment that doesn't really suit them, but you got to make do. I was in a very equity-focused shop and had resources. I definitely had some resources made available to me, but not really always custom built for what we do. Now at Acorn, we've got all the systems and people and everything in place that are solely focused on our mission. So that's a whirlwind history.
Let me jump into something, because you mentioned it again there in your story. We met back in 2001, and I think we were both fortunate in our lives at a similar time to be inspired by somebody who's had some success in this industry. And I was wondering if you might want to speak some about your inspiration and learning some from Ed Seykota.
Yeah, we went down there and obviously spent a week with Ed. It was a wonderful, wonderful week, and met some great people there as well that I still call, that have all turned into some very good friends. That was really the beginning of a long relationship with Ed and the Trading Tribe. And for those that don't know what the Trading Tribe is, I think it's probably most succinctly described as a group of people with a ruthless commitment to excellence and support. The experience with Ed has been great, and the experience with all the people I've met through the tribe is as great. That there's things that I think groups of people can do. They can go places that individuals can't, and I think everybody can benefit from what I call ruthless support. Tribe, effectively, you put yourself into an environment where you are willing and allow yourself and others to be as open as possible with each other, and it's all with positive intentions. So you can say and do things really that might be uncomfortable in a conventional setting, but really, it's about exploring those soft spots, those sensitive spots, those weak spots, and pushing and prodding on them. It was it has been and continues to be an extremely rewarding relationship, if you will, with the Trading Tribe.
Without getting into any secrets, so to speak, even though there's really not any secrets, but without violating any personal privacy or anything, how would you, given that you've had some good experience, how would you best sum up perhaps the most critical lesson that you might have learned from Ed Seykota back in the day?
I think it's I kind of have. I would say that you don't learn so much from Ed. You learn because of Ed, and essentially what that means is you are responsible. You need to think things through, and you can find answers. And a lot of people might go to Ed and just ask him lots and lots of questions. And if you read his website, he's extremely clever often in really just, instead of giving direct answers, facilitating your ability to really do the work. So those going to Ed to try to find the secrets may find initially themselves a little disappointed. But I think the way he serves anyone is to really help support them in finding answers themselves, or in finding the resources to work on those. And also one other nugget is probably accepting the fact that sometimes there are no answers, and you need to be, especially as a trader, I think you really need to be comfortable with the fact that you're going to be, there are sometimes you just don't know why something's working. Just as a baker might not know why his cream-filled dumplings suddenly are selling out like crazy, and then 3 weeks later he's not selling any. He just needs to respond and adapt to that, and who knows why? There may have been some sort of move and move back there, but. You can really free yourself tremendously when you let go of why, and you also to some extent, there's many seekers out there that are really spending a lot of time seeking answers as opposed to looking within.
I think it's a great summation. I think Ed kind of turns the mirror back on you. Let me jump back in though as we don't have all morning, unfortunately, but I want to jump back into some of your trading. And I want to say is that obviously with your style of trading and what you're talking about, this is not something where you have a trading strategy that's predicated on having a bat phone into the Fed. I mean, you are a guy, you are a firm, you're a group of individuals that are making trading decisions based on what the market shows you. And that's quite different, perhaps, when I read today that in the first quarter that JP Morgan made money in 63 days in a row, every day in the first quarter. So I want the audience to understand sometimes there are trading strategies, and I think that's what you're doing at your firm, Jason. And then sometimes there's other things. And I think making money every day for 63 days in a row is something else. I don't really know what it is. I don't think I'd really call it trading, though.
I'll tell you what I think it is. You can almost take every strategy out there and effectively put it into two areas where and really you kind of have a choice. And who'd you say this was? JP Morgan. So this this JP Morgan strategy, assuming it's an investing strategy, what they're doing is they're delivering returns. And eventually, volatility is going to happen. You just kind of got to allow, you have a choice. You can either deliver returns and allow volatility to happen, or you can deliver volatility and allow returns to happen. That's what, So that's what we focus on. So if you look at our transparency report, we also show you our focus on delivering volatility. We can really clearly manage our volatility. You can't manage it every day perfectly, but we as you can see, we'll show you that we oscillate around a volatility level, and we're able to identify volatility, and it's completely up to whatever to when those returns happen, we know we're there. We're going to take advantage of them, and they'll come in lumps. someone just writing options, out of the money options, you can actually measure with precision what your return is going to be on a daily basis, and you're going to be right 63 days in a row. But that 64th day, or maybe the 164th day, or the 564th day, there will be volatility unleashed upon you that you have very little control over. So I'd rather control volatility and allow return than control return and allow volatility. And the challenge, though, is, and that makes total sense, and I'm sure your listeners might think, yeah, that makes a whole lot of sense. But psychologically, people love the approaches that deliver the return, and because it shows spectacular sharp ratios and risk-adjusted return ratios, it's long-term capital. It's you can rhyme off the list of all Madoffs and other guys that show that return stream. It is shocking to me that many people just can't remember that. A year goes by, and after some sort of shock, and people just go right back to the same approach where they want to find the styles that deliver returns and allow volatility to happen. And oftentimes, when the volatility does happen and everyone gets smacked, people are comfortable because everyone else is in the same boat. I spoke to an unnamed large manager that has a style that does this, and he's a very nice guy, good guy. He's in a different sector and has a different mindset. But I asked him about delivering returns and allowing volatility to happen. And he basically said, you know what? Yeah, but if the market's down 35 and I'm down 32, I win. For me personally, that just doesn't resonate.
No, I think you took that nugget with JPM. I could see your eyes lighting up as you heard that.
Yeah.
So let me ask though. So let's talk about strategies like yours. And I know we kind of talked in advance, but let me just ask it this way: where do strategies like yours fit in the context of a portfolio?
Obviously I'm biased, so the quick answer is they fit everywhere. Many, I'll go to the conventional answer first. Our approach delivers returns that are not correlated to the S&P 500, where our correlation's, minus 0.05. And we are just in the process of doing a paper that shows our returns during S&P up months and our returns during S&P down months. We had to go to 4 decimal places to see the difference. Now, that's somewhat of a mathematical fluke at this point in time. It won't always be that close, but it was literally something like 0.8492 and 0.8523, whether it was up month or down month. So as a non-correlated holding that produces returns, and that the important thing to understand is that the correlation is really much more, or the non-correlation is much more stable than other investments. Our approach belongs as a reasonable size weighting in a portfolio. But, I go back to my first quick answer, which was it belongs everywhere. Doesn't it just kind of make sense that no matter what you invest in, it might be a good idea to define at what price or at what point am I wrong? And if I'm wrong, then get out. I really truly believe that approach, probably now more than ever, should be employed across your portfolio in everything you own. We've found that we can apply our approach to a wide variety of conventional, if you will, investments, or even conventional strategies, whether it's high yield bonds or preferred shares or convertibles, real estate, emerging markets, investment grade bonds. It doesn't have to be futures. It doesn't have to be stocks. I'd like to believe that there's a little bit of a revolution happening here with regards to portfolio construction. Ray Dalio of Bridgewater's, is doing some work there, as well as this whole industry of ours. I think, frankly, was way ahead of Ray Dalio. Ray Dalio's got a futures background, of course, and some of these ideas that we apply can really, really benefit an investor's portfolio.
I have one ending question before we wrap up this morning, but I want to give you a quick story. I'd love to get your feedback on it because you talk about how there's some positive things moving. So I've had the chance in the last couple of months, the good fortune to be in front of some of the largest value-based mutual funds in Asia, whether it's Singapore, Hong Kong, Kuala Lumpur, or mainland China. And I was at a fund in mainland China. I can't recall the name, but they were in the top 5, massive amount of assets. And I was going through some examples of some trend following strategies, and they saw some of the typical drawdowns that you might see with a fund manager, perhaps even like a Bill Dunn. And
Right.
they looked at me and they said, well, we can never take a drawdown like that. I said, well, now hold on. He's shooting for a very high yield. He expects high volatility. Not all trend followers are the same. There's different strokes, different folks. And they said, well, we can't take a drawdown beyond 10%. And I said, okay. What happens then? Well, if we have a drawdown of 10%, we give the money back to the client. I said, okay. I said, this is like what, legislation? You have to give the money back? Yes, we have to give the money back. I said, okay, well, I have a question for you. And this is all going through translation. I said, when do you start the strategy back up again? They said, oh no, if we have a 10% drawdown with that client, we lose that client. We never get that client back. We just get new clients.
Wow. Yeah.
So you're saying that there are some people that are making progress. I'm going to tell you right now, that one was not progress.
Yeah, it sounds a little backwards. Definitely sounds a little backwards. And the drawdown characteristics of this general strategy. If you look at a number of the variety of various indices that track managers that use approaches similar to this, and we actually have in our slide presentation, we actually show one of the industry indices versus the S&P 500, and what a phenomenal picture in terms of risk management. It becomes so evident that with the S&P 500 and a passive approach, there's nothing done. It allows to run. It goes to 52%, and there's no process applied clearly. Whereas you look at the Barclays Systematic Traders Index, for example, and you look at the historical drawdowns there, it is there's some drawdowns that get to 20%, never anything really much beyond that, and it's just made abundantly clear that there is obviously something being done that prevents those drawdowns from really running away, and that's simply the act of getting out of stuff that doesn't work. Yeah, it's interesting. It's interesting how I think one of the psychological challenges for anyone that trades or invests in an approach like this is when you're experiencing a drawdown, you're often alone because there's not as many people invested in strategies like these, perhaps, and it's not as widely covered. And it's happening at times, perhaps in the S&P, or equities are going up or bonds are going up. And whereas if you're in the S&P and you're going down with everybody else and it's all over the papers, it's all over the newscast, I think psychologically for many investors, somehow that probably provides them a comfort that they don't get if they're in a strategy that may be going through a 10 or 15 or 20% drawdown. It's perfectly normal, but at a time where no one else is talking about it.
Misery loves company, right?
Misery loves company. Absolutely. Couldn't put it better. That's it.
I got one last question for you, and it's something we had talked about in advance, and we've kind of already covered it, but I mean, there really is nothing more important than risk management, is there?
I've got a little saying that if there is something, it's responsibility. And responsibility is really kind of I call it the mother of risk management, and it goes a little deeper than the standard risk management in that you need to do things like seek simplicity rather than complexity. Size trades with care. When you're wrong, admit it quickly and move on. And that responsibility obviously fosters a strong risk management. But if you really seek to be as responsible, or you are as responsible as possible in everything you do, whether it's the business structure or the environment you're building around you, the people you decide to work with, all of that has a big influence. So I would say if there's anything bigger than risk management, it's simply responsibility.
That sounds good. I mean, I think it is one thing that maybe sometimes people forget. They get all caught up in the idea of just tell me how to make the money. And, sometimes ethics, responsibility, a moral authority is important. I mean, you've got to do the right thing. You don't do the right thing, you might get lucky and maybe you'll make a fortune, but something will always be slightly off. I mean, so doing the right thing, there's something to be said for that.
Absolutely. Yep. It makes things run a whole lot smoother, and you infuse it in the culture of your operation, and it really supports and encourages a strong risk management approach.
So listen, as we wrap up here, where are you at right now? I know you're in Canada. Are you in Toronto?
I'm in Oakville, small town outside of Toronto. We're about 30 minutes west of Toronto.
Okay, well, I'm at the Covel Global Command Center in Phuket, Thailand, calling you on Skype. So I would say we've done pretty well on our connection today.
Yeah, it's a great connection. Fantastic.
Yeah.
Enjoyed this. Thank you very much.
Hey, Jason, what's the best way if people want to find more information? Your website's got some really cool stuff on it. What's the best way for people to reach you?
Basically, go to the website, acorn.ca, and the contact page there has, the various phone numbers and emails to reach us. And we are definitely open to anyone who's interested. And we've really focused on Canada exclusively for a number of years, but we're now looking outside our borders and speaking to some folks in the U.S. as well as around the world.
Well, like I said, I'm some of the things I've seen on your website, I'm a little jealous because I can see the reminiscence of a stock operator, simplicity logic. It always looks simple on the surface, but there's a lot of depth behind it. And I love that kind of writing and thinking. So, cheers to that.
Thank you.
Cheers.
Appreciate that a lot. Thanks. And you do a fine job with your material as well. It's outstanding.
So, Jason, we will talk soon, and I hope to have you on again in the near future.
Great. Thanks a lot. Have a good day.
Okay, take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.